Phase 2 of the housing crash is just getting started, and it could be worse than 2008, but it will not unfold the same way. Just recently, Fed Chair Jerome Powell said that stronger than expected economic data suggests that the ultimate level of interest rates is likely to be higher than previously anticipated, which means that the probabilities are increasing that we see a 0.5% rate increase at the next meeting. So mortgage rates may not get the reprieve that everybody has been hoping for by the end of this year. And even though mortgage rates do not move in lockstep fashion with the Fed funds rate, there is a reasonable correlation. With the recent rise in interest rates, the average mortgage rate is sitting at 6.65%. And that brings the average payment on a median priced home to just over $2,500 per month. And even though that is the highest average monthly payment that we have seen on record, mortgage purchase applications has increased 7.4% month on month, according to the Mortgage Bankers Association. This, of course, could be a seasonal increase, but only time will tell. And despite the higher rates and payments, according to CoreLogic's Home Price Index, their forecast for 2023 is actually showing a year-on-year price appreciation of 3.1%. In addition to that, the most recent Fannie Mae Homebuyer Sentiment Survey suggests that the net share of participants who say it is a good time to buy increased by 5 percentage points month over month. The increased optimism in the housing market is certainly welcome, but inventory levels are still sitting at about a 3-month supply. This is dramatically off the lows, but it's just rivaling levels that we saw in 2019. And the low levels of inventory is yet another reason why we're seeing a major crash in transactions. We're slowing down across the board. We're actually sitting at lower levels than we've seen over the last 10 years. In my view, you have two segments of the market that are sitting on the sidelines. Investors and landlords are not getting involved in the market because the rental rates heavily depend on things like the cost of capital, their taxes, their insurance, maintenance, utilities, and management. And if landlords cannot make money, they simply exit the business. And the other major segment of the market would be your move-up buyer. And these are buyers that are selling starter homes and trading up into bigger homes in different neighborhoods, which means for those specific buyers, there are two transactions. They have a sell side and a buy side. And these are the buyers that are very rate sensitive right now because over the last few years, they locked into record low 30-year fixed rate debt. And they know that if they sell today and harvest their equity gains, they would have to roll that into a new property at a higher price with a significantly higher mortgage rate and payment. It's important to mention that even though CoreLogic forecasts a 3.1% price appreciation on a national level, each and every single market is specific. According to their home price index, you could basically draw a line down the center of the United States to determine which markets are going to fare better than others. And it really becomes a tale of East versus West. They are forecasting that states like Florida, Georgia, and South Carolina are going to appreciate by 7% or more, while states like California, Nevada, and Oregon will appreciate by less than 2%, basically staying flat. In my view, their forecast is very optimistic if you're considering the current economic conditions and mortgage rates. One type of property that is the least likely to lose value is going to be the starter home. So your standard 3-bed, 2-bath, 1,500 square foot property, because affordable homes are in low supply. On a national level, inventory for your typical starter home actually went down by 1.5%, while the middle and top tiers have increased significantly. Who would have thought that all this money printing and fiscal stimulus over the last 3 years could have distorted the housing market so badly? The unfortunate reality is that it will likely take several years for all of these effects to play out. If mortgage rates stay high and supply stays low, the market may grind along at a standstill here for the next couple years, making affordability the biggest problem that we see here in the housing market. That is going to wrap up today's video. If you enjoyed the content, please consider liking, subscribing, and sharing. I would greatly appreciate it. Have a wonderful day. Take care.